Imagine having $100,000 to spend this month. You could lease a fleet of luxury cars or fund a small startup, or if you happen to be a major financial firm operating right now in mid-August 2026, you could buy a 1 millisecond head start on reading a social media post.
And we know of at least 10 major corporate subscribers who are currently choosing that last option. They're paying for this microscopic sliver of time because, in the modern financial landscape, capital basically acts like highly pressurized water. It will aggressively route around any roadblock in its path.
Whether that roadblock is a public internet speed limit, a sovereign national border, or a physical hardware shortage. Our mission for this deep dive into the source material is to look past the dry analyst jargon and uncover the weird incentives driving today's data. We are seeing distinct pressures moving in completely different directions today, not just one neat global supply chain story.
Well, when pressure builds up in a closed economic system, the energy never just dissipates. It finds the nearest crack, the tiniest vulnerability, and forces its way through. And what we're seeing across these sources is that the solutions the market builds to bypass bottlenecks are frequently way more complex and vastly more expensive than the original barriers.
The most literal example of bypassing a speed limit is actually unfolding in a New York federal court right now. The Intercept and the Freedom of the Press Foundation have filed a lawsuit against Trump Media and Technology Group over a commercial service they call the Truth API.
Right. So for up to $100,000 a month, clients receive Donald Trump's platform posts milliseconds before those exact same posts render on the screens of the general public.
Let me pause you right there because I want to make sure the mechanics of this are crystal clear. When we say an API, an application programming interface, we are talking about a direct server-to-server pipeline. The firms paying this premium aren't putting a human being in front of a monitor to read the text and physically click a buy button.
Oh no, that human reaction time would entirely defeat the purpose. The API delivers raw, structured data. We're talking JSON feeds piped directly into a trading firm's proprietary algorithms.
Meaning these algorithms use natural language processing to instantly parse the sentiment of the post without any human intervention.
Exactly. If the post mentions new sanctions regarding the U.S.-Iran war or military movements or tariff adjustments, the algorithm can generate and execute thousands of targeted trades across global exchanges in the time it takes a human eye to just process the first word.
Comparing this to the telecommunications arms race a decade ago really puts the sheer scale of this arbitrage into perspective. Back then, financial firms spent hundreds of millions of dollars laying a perfectly straight physical fiber optic cable through mountains between the Chicago and New York stock exchanges.
Yeah, they literally bored through solid rock just to shave off a single millisecond of trade time.
Now they are paying a monthly subscription for the exact same temporal advantage. But looking at the lawsuit from the Freedom of the Press Foundation, does this officially turn civic political communication into a raw, tradable commodity?
Well, the plaintiffs in the lawsuit are arguing exactly that. They claim this creates a corrupt system where market-sensitive civic information reaches paying corporate clients before the voting public. Trump Media's defense, on the other hand, is strictly commercial.
They argue they are simply meeting a massive business demand for faster data feeds.
And they claim the lawsuit is driven by political activists trying to weaponize the courts. But regardless of the legal outcome, the market mechanism here is undeniable. The market identified a bottleneck, the public internet's standard delivery speed, and built a highly exclusive toll road to bypass it.
Moving seamlessly from bypassing public news feeds to bypassing national borders, we are seeing the exact same underlying mechanism in global wealth management, specifically looking at India's Gujarat International Finance Tech City.
Also known as Gift City. Here in late summer 2026, major global players like BlackRock and Standard Chartered are aggressively setting up outbound funds in this specific geographic location.
If you are listening to this and wondering why Indian financial zoning laws matter to you, consider your own investment portfolio. The global financial giants building this infrastructure are doing it because there is a massive pool of trapped wealth trying to get into the same international markets you are currently invested in.
The mechanism driving this massive infrastructure build-out is India's incredibly strict capital controls. Currently, Indian domestic equity funds are trapped by a hard $7 billion national ceiling on outbound investments.
And that cap has been completely exhausted.
Completely. So resident Indians seeking international wealth solutions simply cannot move their money out through normal domestic channels. The plumbing is effectively sealed shut.
I want to make sure I have the geography and the legality of this straight. Gift City is physically located inside India in the state of Gujarat. But legally and financially, the funds operating out of this city are exempt from those national outbound limits.
Right, that is the precise legal fiction making this possible. By operating within the special economic zone of Gift City, asset managers bypass the exhausted $7 billion national cap. It acts as a legally sanctioned offshore financial center, but located entirely onshore.
If the government recognizes there is massive pent-up domestic demand for global investment, why force everyone to route through a specific tax-sop city instead of just raising the $7 billion national cap? Is this simply about controlling the pipeline and deciding who gets to collect the fees?
Control is the operative word there. Broadly, raising the national cap would mean relinquishing macroeconomic control over capital flight and currency valuation, which is highly risky for any emerging market central bank.
So by keeping the national cap frozen but opening the Gift City valve, the regulatory authorities can meticulously manage the pressure release.
Exactly. They dictate exactly which institutions are allowed to operate the valves. It allows foreign asset managers like BlackRock to tap into the massive wealth of Indian investors while simultaneously building up a brand new domestic financial hub designed to compete with Dubai or Singapore.
It is a brilliantly engineered regulatory bypass. And speaking of engineering massive pipelines for capital, the physical infrastructure being built to route around the global artificial intelligence compute shortage is staggering.
The structural bottleneck for AI graphic processing units, or GPUs, is demanding capital expenditures on a scale we rarely see in peacetime. I mean, look at the balance sheet for CoreWeave right now.
Their revenue just jumped 112% to $2.58 billion. But to achieve that revenue, they are carrying $35 billion in debt just to hoard NVIDIA chips.
The debt dynamics at play here are operating on an extreme build it and they will come philosophy. CoreWeave is highly leveraged because their entire business model hinges on the belief that the bottleneck for compute power will only tighten further.
So they absorb massive debt to secure the physical hardware and then pass the component price hikes directly down to their customers, locking in their margins today.
Meanwhile, Tencent is taking a totally different approach to their own capital expenditure. They just hiked their quarterly capex by 65% to $7.8 billion, specifically to build out AI infrastructure.
Are they acting as landlords in the same way, just renting out server space to anyone who needs compute power?
Actually, Tencent is intentionally choosing the harder path. While they could generate immediate, massive returns by simply renting out their new compute capacity to third-party developers, they are using a significant portion of it to train their own internal, state-of-the-art proprietary models.
They are actively absorbing massive negative free cash flow right now, reporting negative 13.8 billion yuan in their last quarter.
The internal calculation is that owning proprietary AI models will deliver vastly superior economic returns over a 10-year horizon compared to simply being a utility provider for server space.
Companies are spending hundreds of billions of dollars on these chips. But I have to contrast this frantic global spending with the human adoption data coming out of certain major economies, specifically Japan.
Right, because right now, roughly 50% of workers in the United States are utilizing AI tools in their daily workflow. In Japan, that number is only 8.4%.
You have Japanese hospitals still struggling with physical paper files, and major corporations absolutely refusing to integrate generative models into their core operations. If strict, risk-averse AUKUS cultures refuse to adopt the technology because they demand multi-step human reliability, are we building a multi-trillion-dollar bridge to nowhere?
It definitely highlights a profound disconnect between capital expenditure and behavioral economics. You can borrow $35 billion to build a state-of-the-art data center, but you cannot force a risk-averse corporate culture to inherently trust the output of a machine.
The fear of reputational damage seems to be the ultimate bottleneck there. A traditional consensus culture requires zero errors. If a human makes a typo, there is a chain of accountability.
But if a generative model hallucinates a number in a critical financial report, the reputational fallout for the executive who implemented the system is catastrophic. Until the technology can guarantee flawless, auditable reliability that satisfies traditional compliance cultures, all of that expensive physical infrastructure will remain fundamentally underutilized in those specific markets.
It gets relegated to highly isolated, low-risk tasks, like summarizing internal meeting notes, which certainly does not justify a $7.8 billion quarterly capex hike. Discovering new frameworks and keeping up with these massive systemic shifts requires constant learning, which is why you can find financial candy, brain candy, and classic audiobooks at claireandhoratio.com to keep your mind sharp while the ground moves under our feet.
And speaking of Japan's cautious approach to adopting new technology, the contrast with how wildly aggressive their central bank has to be right now is fascinating.
The Bank of Japan is handling a totally different kind of pressure this August 2026. They are desperately trying to defend the value of the yen, which hit 40-year lows earlier this summer.
Yeah, it plunged past 160 to the dollar. To combat this freefall, Japan deployed roughly $85 billion in a historic two-day operation in July just to prop the currency up.
It was the biggest foray into the currency markets since the immediate aftermath of the Fukushima disaster in 2011. Before we get into the scale of that $85 billion mechanically, walk me through how a central bank actually executes an intervention of that size. If Japan holds $1 trillion in U.S. treasuries, they can't just dump $85 billion worth of them onto the open market on Tuesday morning.
No, dumping that volume of U.S. treasuries directly onto the open market would trigger a catastrophic spike in global bond yields.
It would completely destabilize the very financial system they are trying to protect.
Exactly. So instead, the Bank of Japan utilizes the Federal Reserve's FEMA repo facility.
Let's break down the plumbing of that repo facility.
So FEMA stands for Foreign and International Monetary Authorities. A repo, or repurchase agreement, is essentially a highly secured, short-term pawn shop for central banks. Japan pledges its U.S. treasuries to the Federal Reserve as collateral.
In exchange, the Fed hands Japan the physical dollar cash it needs to go into the currency markets and buy up its own yen.
And the Bank of Japan agrees to buy those treasuries back at a later date, slightly higher than the original price, which covers the interest rate of the loan. This allows Japan to access massive amounts of dollar liquidity instantaneously without ever having to actually sell its underlying bond holdings.
Goldman Sachs noted recently that with over $1 trillion in reserves, Japan has plenty of capacity to keep defending the yen. But if the underlying problem is that you simply make more interest holding U.S. dollars, doesn't throwing $85 billion at the market just create a temporary wall that traders will eventually climb right over?
It comes down to the undeniable math of the carry trade. Right now, an investor can get a 4.69% yield on U.S. 10-year bonds. In Japan, the equivalent yield is a mere 2.839%.
So as long as that interest rate differential remains at wide, institutional investors have a massive financial incentive to borrow money cheaply in yen, sell that yen to buy U.S. dollars, and collect the higher interest rate in America.
Right. You are fighting basic mathematical gravity. Currency intervention is fundamentally designed to buy time and inflict maximum pain on speculative short sellers, not to offer a permanent fix. The July intervention certainly created a psychological shockwave.
Traders are terrified of sudden, massive central bank drawdowns, which makes them highly wary of aggressively betting against the yen. But fear only lasts so long against the guaranteed yield gap.
Unless the Bank of Japan aggressively hikes its own domestic interest rates to close that differential, or the U.S. Federal Reserve cuts rates due to cooling American economic data, the foundational incentive to sell the yen remains completely intact. Market participants are doing the math every single day.
You cannot permanently engineer your way out of a multi-percentage point yield gap using repo facilities alone. We have spent this entire time talking about how billions of dollars can engineer sophisticated pipelines around legal, technical, and macroeconomic roadblocks.
Yeah.
But sometimes, no matter what the price mechanism is, raw consumer psychology completely overrides it.
Oh, absolutely.
Let's bring this down to the ground level and look at the produce aisle. Lettuce prices crashed by an all-time record of 16.4% in July.
It is a textbook example of a brutal boom and bust cycle colliding with human biology. First, prices for lettuce spiked heavily due to a combination of geopolitical and domestic pressures.
The ongoing war with Iran caused a massive surge in the cost of global fertilizer.
While mass deportations initiated by the Trump administration resulted in severe agricultural labor shortages, driving up costs for U.S. farms. So the price shot up, and then the bottom completely fell out of the market.
The catalyst for the crash was a massive cyclospora outbreak linked to a specific processing facility in central Mexico. The contagion completely obliterated consumer demand across the continent almost overnight. Usually, standard economic theory dictates that a 16% price drop brings bargain hunters rushing into the market.
Right. In a traditional supply and demand curve, significant price deflation stimulates immediate consumer purchasing. But when biological trust evaporates, that logic simply ceases to function. Retailers can slash the price of a contaminated product to practically zero,
But if the consumer inherently believes the product is fundamentally unsafe for their family to consume, the transaction will not occur at any price point. It is the equivalent of putting a 50% discount on a parachute that might have moths in it. It proves that in consumer markets, biological trust is the baseline currency before a single dollar is ever spent.
We saw major fast casual chains like Cava, Chipotle, and Taco Bell feel the immediate impact of this demand shock, even if their specific proprietary supply chains were totally uncontaminated and rigorously tested. The consumer just walked away from the entire category of leafy greens.
It is the ultimate market roadblock. You can use a sophisticated Federal Reserve repo facility to defend a sovereign currency, or leverage $35 billion in corporate debt to hoard server hardware.
But there is no financial derivative, no API feed, and no regulatory loophole that can force a panicked consumer to eat a salad.
Taking a step back and looking at the overarching pattern across all the source material, a very clear reality emerges. Markets will pay almost any price and invent almost any mechanism to route around a structural bottleneck.
We are seeing capital pay $100,000 a month to bypass standard public communication speeds. We are watching asset managers build an entire offshore hub onshore in India to bypass strict capital controls.
And we are seeing tech giants absorb billions in negative cash flow to bypass a global GPU shortage. Capital always finds a way through the cracks in the system. But as the lettuce deflation perfectly proves, once basic human trust is broken, no amount of price manipulation or sophisticated financial engineering can force a transaction to happen.
It is a profound reminder that while financial systems are incredibly adaptable and can engineer pipelines around almost any technical barrier, they ultimately rest on a very fragile foundation of human behavior. When that behavioral foundation cracks, the cleverest market mechanisms in the world simply stall out.
I'll leave you with this final thought to ponder as you navigate your own professional landscape. What is a massive structural friction point in your own industry right now, and who is quietly building the $100,000 API or the regulatory gift city to bypass it? The roadblocks are already there. It is just a matter of who figures out how to route the pressurized water around them first. Catch you next time as we continue to track exactly where the pressure is building.